Hi friends, today we are going to look at income from other source. This is one of the topic from direct tax. Income from other source. To understand the income from other source, let us see introduction part of the income from other source. Introduction. Income from other source is a residual head of the income. That is, if an income does not classify in the first four heads, that is salaries, income from house property, business or professions, and capital gains, then it is treated as a IFOS. Let us see total introduction part. Income from other source is a residual head of the income. That is, if an income does not classify in the first four heads, that is salaries, income from house property, business or profession, capital gains, then it is treated as a IFOS. The above sentence, that is what we have learned in introduction, that is does not mean every receipt is a IFOS. First and receipt should meet the definition of income, and then classification goes on. What does here classification means? That is the classification whether goes salaries or income from house property, business or profession, or capital gains, or income from other source. For example, for the above sentence, if pocket money received by a lady from her husband, here above as pocket money received is a receipt, but it is not an income, so there is no classification and it is not treated as a income from other source. Now we are moving to analysis sections of IFOS. In that first section, section 56 is a charging section of IFOS, and section 57 deductions allowed from IFOS, and section 58 disallowance, that is deductions not allowed from the IFOS. So in IFOS, the following incomes are mandatorily as IFOS. What are they? One is dividend, and second one is winnings, and third one is income from the activity of owning and maintaining of horses, and interest, and the fourth one is interest on compensation in relation to capital gains transfer. So let us see once again. The following incomes are mandatory as IFOS. One is dividend, and another is winnings, and third one is income from the activity of owning and maintaining of horses, and the fourth one is interest on compensation in relation to the transfer of capital gains. And the fifth one is amount received and forfeited in relation to a failed transfer of capital asset. Where the forfeiture take place on or after 1/4/2014 under section 56 subsection 2 and subclause of 9. Now we are going through tax treatment of dividend. Now dividend of two types, that is dividend received from Indian company and the dividend received from foreign company. Now this dividend received from Indian company as again divided into two parts. One is interim dividend, final dividend, section 2 subsection 22 clause A, B, C and D. And other part is section 2 subsection 22 and clause E. Now whether DTD is payable by declared company. That is dividend received from Indian company, and part 1 is payable and another part is not payable, and from dividend received from foreign company is also not payable. So now what will be the tax treatment for this? Tax treatment is for which the DTT is paid or payable, it is exempt, and other two, that is section 2 subsection 22 and clause E, is taxable, and dividend declared by the foreign company is also taxable as an income from other source. From this chart we can clearly see that first dividend is divided into two parts, that is one dividend received from Indian company and dividend received from foreign company. Now again dividend received from Indian company is also divided into two parts, and first part it is DDT is payable, so it is exempt from tax, and second part, that is section 2 subsection 22 clause E, that is dividend DDT is not payable, so it is taxable in the hands of shareholder. And last, dividend received from the foreign company, it is also not paid as a DDT and it is also taxable under the head of income from other source for shareholders. Now what is section 2 subsection 22 and clause E? What is it means? That is, let us consider an example that here this person had a shares in XYZ Limited, that is a closely held company, that is greater than or equal to 10% of equity shares. Now Mr. A has a 10% or greater than 10% of equity shares in XYZ Limited, that is a closely held company. And this person also had a substantial interest in partnership firm, that is PQ or partnership firm. So this person is having equity share capital in XYZ Limited and holding substantial interest in PQ or partnership firm. Now XYZ company gives a loan to PQ or partnership firm, so that amount, that is loan amount, is treated as a dividend under section 2 subsection 22 clause E. Same as this, if XYZ Limited gives a loan to any relatives of a shareholder, then it is also treated as a dividend. See, the XYZ Limited gave a loan to sister of shareholder and that treated as a dividend under section 2 subsection 22 of clause E. Now, what is the tax treatment of winnings? Winnings, bettings, gambling, crossword puzzles, and income from TV shows winnings are taxable at a flat rate of 30%. To make a winning, any expenditure incurred, such expenditure not allowed as a deduction is not allowed as a deduction, as gross is taxable. And winnings are not allowed as a base exempt. What it means, if you don't have any income from salaries or income from house property, capital gains or business or profession, if you have only income from winnings, you should be payable at 30% of a tax rate. And in negative winnings do not have any intra or interhead adjustments, so any negative winnings have to ignore. And for winnings, 80C to 80U deductions are not allowed. Now, income from marriage. If an assessee is engaging in the activity of owning and maintaining of racehorses, then the income from such activity is to be offered as income from other source. One should not be an opinion that an income from the activity of OMRH is taxable at the rate of 30%, as this income is not as a betting of horses. So it is not at the flat rate of 30%, it has a some other percentage, that is which is we have to payable. Any expenditure incurred for OMRH is allowed as a deduction and the net income is taxable. OMRH may have a negative income, that is such loss can be adjusted only from OMRH income. So, therefore we can carry it forward for such loss for 4 years subject to the return of income.